Hi, I'm Hunter Hutt, Director of Business Development, and today I'm here with SVP Portfolio Manager Andrew Torres. Today we're here to discuss the recent performance and opportunity set in our alternative investment grade credit mandates. July was another steady month for credit assets as the grind continues. As such, our alternative investment grade credit mandates were able to provide their customary low volatility, capital preservation, and produce their 16th month of consecutive positive performance. Andrew, can you touch on the main contributors to performance throughout July?
Yeah, it certainly is feeling a little more defensive, perhaps than we'd anticipated in July. We did see U.S. credit spreads widen up to about 10 basis points in some cases. And in Canada, a little bit of widening, not quite as severe. As such, we were focused on keeping the portfolio turning over. We made some adjustments to our risk profile. And overall, we were able to at least preserve some of the natural yield in the portfolio to ensure that we continue to produce positive results.
Thanks, Andrew. And how are we setting up the portfolio?
Well, we've made a couple of key changes in the last few weeks. Most notably, we've been reducing our U.S. exposure really beyond 5 years. We're now net short U.S. credit. And in Canada, we've done similar where we've put more of a steepening bias on. So we've been adding somewhat to short end exposure, but then going net short beyond 10 years in Canada. Both of these things are designed to be a little more defensive. And we've really focused some of that risk reduction in and around the bank space, US and European banks specifically.
Andrew, Jackson Hole is a Federal Reserve meeting that occurs this month. Is there anything our investors should be cautious of pre or post meeting?
Yeah, it's easy to discount Jackson Hole, but you have to remember that quite often this can be where the Fed introduces new initiatives. So just last year in August 2020 at the Jackson Hole meeting, they really introduced this concept of average inflation targeting, which, as we know, has driven the rate bias for much of 2021. So we think there's a good chance that they start to talk about the taper. We have seen some Fed governors already coming out and making a case for tapering. And even though we don't think they'll formally announce the start of the taper, we think that it could start to be discussed as a potential Q4 initiative. And that can mean a lot of different things. It can start to change the way the market's responding. You could see rate curves rise, rate curves steepen. You could see back up in risk markets, so equities down, credit spreads wider. So we just want to make sure that we're defensively positioned just in case something unexpected happens.
If you have any questions, please feel free to reach out to a member of the team. Thank you, and have a wonderful rest of your summer.